We're good to go. Hello and welcome, everybody. Thanks for joining us today. My name is Tim Graham, and we've got a really important topic to cover today. One that's at the forefront of many investors' mind: inflation, interest rates, and of course, what's next for the property market. Australia's inflation rate has just hit a four-year low of 3.2%, edging closer to the Reserve Bank's target range of 2 to 3%. With the next RBA meeting coming up in February 18, many experts are speculating, will we finally see an interest rate cut? And more importantly, what does this mean for borrowers, investors, and the broader property market? And to help us break it all down for us today, I've got a very special guest, Lucky Velasquez, to help us break it all down. So, Lucky, welcome back. Thanks for
What
having
is
me.
up?
How are
Hello.
you?
Hey everyone. How you going? Tim, I'm well. I'm
That's all right.
good. Yeah, I'm good. I'm good. Still got the babies and still not sleeping. So I'll do my best
That's all right. I don't see any
today.
no toothpicks in your eyes to keep your eyes open or anything, so you're doing
Not
better
yet,
than
not
us.
yet. Very close to it though. But
Good
yeah, if
man.
you guys are parents out there, I know what you guys are going through. So it is what it is.
Very good. All right, mate. Now, listen, we had a quick chat off
Mm,
off camera, and you've got a presentation to take us through today. So, if you want to
yeah.
get that up, and just a bit of housekeeping for everybody, we're aiming for about 45-minute chat today. We are going to allow about 15 minutes for questions at the end. You're welcome to ask questions in the Q&A box throughout. We'll answer anything that's pressing at the time, but if not, we'll try to get to as many of your questions at the end of the session. Over to you,
Awesome.
Lucky.
Hey, Tim, I think can you just oh yeah, cool. Fantastic. Sorry guys, bit tech issues here. Awesome.
Yeah, for it.
Wicked. Cool. First, you guys can see this. Tim, can you see it?
Yep, we got you now.
Fantastic. Guys, thank you so much for coming through. I've always dropped off and I try to make topics a bit entertaining and deliver it in a way that's a bit more simpler to kind of absorb. So today I'm going to do that. Today I don't want to talk too heavy on the topic. We are seeing a lot of the topic on news, and I'm sure it's everywhere at the moment. But I want to try to make this as conversational as I can to kind of allow for questions at the end. So our agenda today is going to be fairly simple. We'll talk about recent trends, talk about really what RBA does for the people that don't know. I know there's a couple of first-time investors that's here. What's the forecast for 25? Obviously, impact. And then I'll talk about some strategies and kind of how to increase borrowing, what you need to definitely start to look out for. That's been a big one to get that nearly every single day. So that's the stuff that we'll kind of talk about today. But again, PG rating, house rules, a little bit rough around the edges. I will try my best not to swear
You did well
because
last time.
Tim,
We got through a whole webinar without
man,
last time.
shut up, Tim. Like seriously, bro. You had no idea how much I was holding my mouth, but it is what it is. But do note that this isn't advice. So please seek professional advice prior to this opinion, not advice. Again, guys don't know me. This Malteser head. My name is Lucky, and funnily enough, we have been ranked finalist 2025 for Residential Mortgage Broker of the Year nationally, as well as Rising Star. So that's cool. And if you guys haven't saw the last ticker interview, my suggestion is to watch it because we talk a lot about some deep topics about guarantors and all these kind of random pieces, which will affect you definitely, and the people watching here affect them and their life definitely when and if rates are cut. So again, just some cloud stuff here. And as you know, FinanceBetter is partnership with Hotspotting. So right at the very, very end, we've got some special gifts going to the Hotspotting crew and the Hotspotting family. As you guys know, my vanilla brother here is Tim. I just want to
Really?
put that in
You
there.
look,
It
I look
just to be
very
like,
white
yeah,
in front of this screen, I've got to say.
I got a white brother.
Yeah.
That's it.
I might have to
So
go with the
let's
black
kind of
background.
yeah, exactly. So look, let's talk about kind of RBA and policies, what their roles are. So first and foremost, we've got to understand monetary policy. What does RBA really do in fundamentals? They've got to conduct monetary policy. They've got to make sure that the interests are in line for obviously economic growth. And then they're trying to push some obviously financial system stability. And last one is to issue the nation's currency. So we've just got to understand kind of what that looks like. Now, we know for an absolute fact that the targets are going to be like that 2-3% over the medium term. That has to be the target. And what they've been talking about and preaching out for the last couple of months, even though everyone was kind of bleeding with the interest rate hikes. So what can they do with this? There's a couple of things that they could do. They can cut interest rate, which I'll show some slides after, which will be on the premise that it's going to stimulate economic growth. And then the last one is to maintain current rates. It's only going to be two moves anyway, right? Maintain current rates. If they hold steady, it probably may be because they don't want to um, create another insane boom that's going to having to draw that back again, holding it or even increasing the rates again. They don't want to probably do that. It'll be a PR nightmare. As well as obviously the election on the US, with the tariffs being involved, and especially being Australia being close to America, but also very strong link to China in terms of our resources, could be also kind of a signaling understanding of what that may look like. So where am I on the fence? I am 70-30 that rates would cut, but just a heads up, that's really why I think they could kind of maintain the rates if they do maintain the rates.
So what
Now,
you're saying, Lucky, is
tell
that
me.
there's you think there's a 70% chance we'll see a rate reduction at Feb 18? Is that what you mean?
Correct. Yeah,
Okay.
that's what it's signaling at the moment. The thing though is why I'm not 100% is because again, we're going to an election now where it is the start of the year. There's been a lot of spending happen on December. We already know that. We follow pretty closely to the US and what the US is doing. I kind of feel like another state to the US at the moment, but they've got the tariffs, which implies China. And we're very, very
Potentially on
closely
Mexico and Canada as well within
correct.
next month.
And because of our relationship with, probably not as closely as say Canada or Mexico, but definitely with our Asian counterparts, is that going to then affect the way that business is going to be conducted through here with the relationship with the US? So that's that. Also, we know that RBA has gone through a massive PR shakeup, right? RBA didn't do very, very well when interest rates was kind of peaking in and going through that. So if they cut it, only to increase it again, like it's just going to have an uproar. So
Yeah. So there's repercussions of it cutting too early.
correct. That's exactly it. So hence why I am sold that they will cut, and I'll tell you the reason why I feel like I'm sold there, but I'm not sold completely. But I feel strongly about the topic saying that there will be a cut. So and this is just a nice graph to kind of highlight what that looks like. If you guys have seen this, great. If you haven't seen this, you could kind of see where we sit. So it's been the lowest since 2020, right? We are seeing kind of December, even December 20, kind of December 23 there. Like we're seeing kind of the peak of that inflation. And we're kind of seeing that ease happening. So you can see now kind of where we are at in this graph that there is going to be some downward pressure that it will have effect on the potential rate cut. Again, I feel strongly about this number, but at the same time, though, we did have a big spending in December. So it'd be interesting to kind of see what RBA takes on it, but there is some downward pressure there, which is pretty good. And then again, same thing. So Australian inflation rate has hit a 4-year low. So you can see there again, close towards 24, we are seeing that kind of downward pressure from it, where we are kind of getting into, like, if you look at that 0.3 lines, you can see we're actually entering that part, that moving average. So it would be interesting to kind of see if this is enough for the RBA to be like, you know what, we are going pretty close towards our target. Maybe now we cut it, or do we just hold it until we're really in that category? Tim, what's your thoughts?
Well, I think you talked about the US election, but I think the Australian election is going to have a big play in this as well.
Mm,
And,
yeah, I agree.
they, it's going to be working towards Labor's favour if we can start to see some rate cuts. Otherwise, people will be voting with their wallets,
Yeah,
their wallets that are
absolutely.
hurting by the time we
Yeah,
come around to the Australian federal election.
yeah, exactly. And you could kind of see this here. Again, I do like to kind of show some graphs. These probably reflect exactly the same thing that we spoke about. To a lot of people, they don't really care about this graph. They just want a rate cut. Let's be straight up. Like we're like, oh, I don't really care what this tells me, but is because the rate cut
So
is
you're going to
what's
have,
going to affect me and my portfolio and what I'm going to do personally. So I get it, but it's just
mm,
nice to understand where that kind of look like. And you can see here again, we are reaching towards our target, and
mm,
that's why I'm 30% not sold, is because we're touching on that target.
yeah.
So if we
They
drop
might
it,
want to, you're saying they might want to see it remain there for, consecutive
yeah, correct.
quarters.
Like some of the big four banks have dropped rates, which I'll talk about in a
Yeah.
second.
Yeah.
But at the same time, though, whilst they have uh, dropped those rates, some of those majors have actually been talking about more of a rate cut close towards May than Feb,
Yeah.
right? So where would I like to see it? I'd like to see a rate cut.
Mm,
That'd be awesome. Um, but again, I'm not completely sold on it just yet.
mm.
So obviously, factors contributing that decline. There's the energy subsidies, and there's been decrease in non-discretionary spending. That's a no-brainer, right? Like interest rates are high for a lot of family members, for a lot of families.
Mm.
So you are going to be a bit cautious with consumers, and again, the supply chain stabilization. You can argue that there has been some stabilization. However, there is still bottlenecks going around, and I do think that I'm just very cautious about the tariffs, US, China. I'm just really
They
seeing that
could,
as a
they could
big,
change
big,
again. Yeah.
big change and that big factor to it. Um, so just more of a heads up. Now, this is why I think waiting could backfire though. So if they do the rate cut and you're not in the property market yet, or you're kind of sitting the fence if you should acquire a property or the next investment, whatever the case may be, I do think that it could backfire by waiting around because the moment that RBA does decide to cut these rates and there will be a massive move to the consumer confidence, and they're going to be like, let's buy everything up. There's going to be, um, I think they're going to have maybe a little boom until we see maybe the next say, 2 or 3 cycles of the RBA, and
It's
you could
interesting.
already
It's
see it.
interesting, Lucky. I'm in two minds around that. I mean, I can tell you now through the hotspotting, analytics, we've seen a big boost this year in,
Mm,
website traffic, report sales, more memberships, and certainly even through advocacy and things like that, a big uplift in investor sentiment. There's no doubt about that. But when we think about interest rates, I mean, interest rates. If we see some cuts, I mean, what are you expecting you're going to see over the next 12 months? 0.5 for the year? Like, it's not going to be enough that it's going to move the dial from, a 6.5% to 4.5 or anything crazy that's
I
going
get it.
to hugely improve your cash flow.
It probably won't, but it will probably have the people that's sitting on the fence for the last 12 months to just get them over to be like, I should do something now.
Yeah, I think it's
Like,
it's the borrowing capacity is the big one.
yeah, I think it's going to more play on people's psyche than it is going to be on financial literacy.
Yeah.
That's the truth. Like we've had some pretty big movements, even with the rates being where it is right now. And that again, full truth. That
Mm,
is we're seeing already confidence in property markets and sort of marketplaces, not enough stock to go there.
mm,
So, and there's been a lot of people that has been on the fence.
mm.
Those people that just needs a little bit of certainty, they are sitting there. Like some
Yeah,
lenders are at all-time pre-approvals. They don't even want to do any more pre-approvals because they're like, you're not executing these pre-approvals anymore. So
yeah,
some
wow.
lenders have just pulled out of that pre-approval game, which then tells me that if we have even a smallest rate cut, it will push the people on the fence and it will tip them to be like, let's
Well,
ride.
yeah, it's interesting reading some articles over the Christmas break. One of the statistics that I found really interesting was that if you look over the last 10 years, in terms of listing volumes, we've got 10% less listings
Mm,
today than we did 10 years ago, and yet the national population's grown by 4 million people in that time. And
nuts.
so I can see it's not only through, it's not only because of sentiment that people haven't been buying. It's also been very difficult for people to buy. They're also nervous that if they're, it's their owner occupier, they're selling and having to buy in the same market as well. And there really is a lack of inventory. So, and certainly quality inventory. So even when that, if there is that flood to the market with investors that you're
Mm,
saying, it's going to, push prices up dramatically just because there's more demand.
yeah, I agree. And then the other consensus in that specific statement that you say is for the people that have been pre-approved, um, the properties that they probably wanted to buy, they're probably priced out of that market now.
Hmm.
And that's going to be now a very interesting story. Is it going to really push us more regional again versus kind of capital cities? So it'd be an interesting topic to kind of see what that looks like. But we have we have based on study and what we've got, I think that the rate move, whilst it's not drastic on finances, yeah, it's not going to be like a saving of like 20 grand a month. But if we see that it's going to tip the people that's been on the fence, it's going to have more impact on people's psyche than the back pockets, which will then give them more positivity
Mm.
to jump into the property market that they have been sitting on the fence about.
Yeah, I think it's
So,
that. I think that's the FOMO moment, and
mm,
I remember 2020, 2021. That was that FOMO market where everybody just went. We all know that it's a good time to
mm,
buy, and when everybody's trying to buy, prices go nuts, and that's that COVID 4 year boom
mm,
that we saw. So
I
if
agree.
we head back into that territory with the lack of listings and lack of volume of builds, we're going to be in a lot of trouble here.
Yeah, yeah, exactly. Okay, cool. So, interest rate cut predictions. Will 2025 be the year? Let's pray to whoever you pray to that it is.
Yeah.
So, I think 2025 is going to be the year that we do see a rate cut. If it's not February, I think we will see a rate cut in 2025, and that's the goal. So, we are. A lot of major banks have been already in talks about it, and we'll go through some of the majors. And I'll
Yeah.
just do the four, just to kind of get their thoughts, and I'll give you my opinion on what that looks like. So NAB is is going to see maybe that the first rate cut going to be May 2025,
Mhm.
which will kind of hold steady till 2026. Do I agree with that statement? No, I don't. I think we are going to get it closer. Why? Because as of recent, NAB actually cut their fixed rates. So that's very interesting. So if they are doing that, they're basically already predicting that the cost on cash may be a little bit cheaper, hence why they are cutting
Mhm.
fixed rates. I don't really look at variable rates as a tip, guys, because variable rates is that there's so much variables to it. Yes, there's impact, but fixed rate is probably a best indicator to when it does. And FYI,
They always,
non-bank.
they're a forward mover as well. They move first.
Correct. And usually, if you guys, we talked about the big four, but the non-bank lenders, fixed rates have actually moved
Mm.
closer towards kind of mid-Jan, mid
Yeah.
to early Jan. So just a heads up there. CBA forecasted to see a rate of 3.35 by December 2025. Oh, what a statement.
Mm.
Do I believe in this statement? I do. I'm bullish, more close towards this statement. I think we're going to get probably waiting until that election. We're going to get
Mm.
some movements. Westpac kind of in line with NAB there, but again, WBC rates, St. George and its subsidiaries have already started to drop rates, and we've actually seen a couple of them go through. ANZ Feb 2025, which is more kind of in line to what it is.
Yeah. Let's go with that one.
No, yeah, I know, right? And remember, just a tip, guys. Every single time I kind of show these slides, I want to just give little nuggets here and there.
Mm.
Remember, there is two rates that the bank holds.
Mhm.
Two rates. There is front book and there is back book. Yeah, remember that. I don't care if you have a
Elaborate on that
broker or
for us, Lucky. What's that mean?
hectic. A front book is the new rates that attracts new customers. Yeah.
Yeah.
A back book is the rate you have been assigned to when you got that, and think of it as more the rate
Existing.
for existing clients.
Yeah.
Maybe it's a profitability move. Maybe it's there's just so many factors that go with it.
Mhm.
When people go for pricing, so when they go, hey, I wanna discount my interest rate, um, usually there's some discretion on the back book. Yeah. But if you really want front book, you either have to do an internal refinance with the current lender you're in, and or you have to refinance out to get the front book. So usually I'm in threads where they're like, hang on, there's a promotion gone out by the majors. I'm with the major. I went for the a pricing, but they didn't even give me front book rates,
Mm.
and that's the difference between front book and back book. So just
It goes to
a heads
show
up.
why there's no loyalty with banks, though. Like they save their best offers for new business and don't look after existing. It's just madness.
Yeah, I actually never understood that.
Mm.
Again, it is maybe a bigger business play, but front book, back book, don't learn anything from today. Just remember that. And what you want to
But it's
aim to do is
why you
get
need a
front book.
good broker and not go direct to your lender.
Yeah, I know a very good broker. FYI. Cool. And most likely this is towards investors because not spotting, but and most of our clients are investors. Now this is another kind of chink in the armor.
Mhm.
Are you going to be looking at interest rates or will you look at policy? Now, I have been a massive advocate for policy because it is what growing investors need more than interest rates. Will the affect investor profiles, or is policy going to be still the main focus? I truly believe if you want to grow a portfolio, if you want to acquire property, yeah, and that's multitude of property, you should be looking at policy. Like that should be your go-to first, and then getting the cheapest rate there.
Yeah.
What we've seen, and I have seen this, and we have seen this common, people go interest rates, they don't qualify for a lender, they get declined, they get a hit, they apply it on a different lender, it goes on their credit file. They're like, what happened to that lender? And you're like, we got declined. I don't want your business, thank you. So
Mm.
it is very important that your broker, or if you guys want to do it yourself, whatever, but your broker or myself, we look at policy first. It is going to be the better process versus just purely looking at interest
Yeah,
rates.
it's worth exploring a couple of examples on that because I know I had a customer recently who was a first home buyer who was buying as an investor. They're going to be a rent investor, and they were renting with their partner. And one of the lenders said that, well, I know you're only paying 50%, but they're actually going to attribute 100% of your boarding at the rental
Yeah.
towards their serviceability. So basically, it was an NQ, non-qualified to
Mm.
most lenders, and then changing to the right lender, they said, no, that's fine. We'll allow you to only contribute the 50%, and that gave him a 450 BC as an example.
Yeah, of course.
It's
And
there's
and
plenty of
and what
examples
we'll
like that.
yeah, and what we'll notice is the interest rates is not a big factor in realness. And the reason why I'm saying it's not really a big factor is because the discrepancy isn't massive. It's not like
Mm.
you guys are initially getting a 4% interest rate and then you went to policy and now it's 7. Like
Mm.
it's not a 300, 400 basis point difference, right? It is a couple of basis point difference, but that effectively gets you into a potentially better property with a better borrowing capacity that could look at the circumstance differently than just focusing on interest rates. And this is just more of an FYI because
And
a
also,
lot
it's
of
just
people
a,
do
it's
get
almost a buyer beware that, you could be going into a policy that does give you that you might only have a 2 year interest only period, but is there going to be another lender at the time that you need to refinance that's going to give you the lending again? Because otherwise you could be getting a nasty surprise when you roll over to P&I.
I've got a client right now. Beautiful topic. He's self-employed. Yeah, I won't say his name because
Mm.
obviously he's self-employed, right? Yeah, we had to go through a low doc, mid doc process because the tax return hasn't been completed yet. So he has to get into the property. He got himself an amazing property, right, for acquisition. That property has kind of already gone 30%. He's done his tax returns now, right? And then he just refinanced to a different lender.
Mm.
Instinctively people go, oh, I just have to go to the cheapest lender first and foremost. But you have to look at the next forward plan and go,
Mm.
okay, cool. I'm only out by 20 basis, 30 basis points here. No problem. So I get into the property that's probably increased more than just the rate. Then
Yeah.
I move into the next phase. Maybe it's just chasing interest rate when I have proper documentation, especially if you're self-employed or anything of that nature. So
Yeah.
that's why for me, policy has to take precedent. If a broker or a bank is just pushing you interest rate, and that's the only sales ability, interest rate, it's not a strong enough or compelling reason why you should move to a different lender.
Yeah.
It's not compelling enough. Just a heads up. So these are kind of so I feel very passionate about this too.
Well,
Like I'm just like, come on. And expert strategies to maximize borrowing capacity. We will do this. And so just a reminder, first and foremost, start reviewing your credit score. Yeah, big one. Banks now are doing instant declines on credit scores. So when you do instant decline, you do submission, it submits through, it's just get a decline, and it's a hard decline. Usually there's a soft decline and a hard decline. When the system declines it, 9 times out of 10, you could argue it doesn't take ages. 9 times out of 10, if it's going to be a hard decline, they don't want the deal, go somewhere else. So please review your credit score, stop applying for afterpays and zip pays and all that little bits and pieces. That's we don't do that. Yeah,
yeah.
do not do that. So number one, review your credit score. Very important to do. And what's a healthy credit score? Like 6-ish, 7-ish, anything kind of below that, like you probably need to start really looking at non-bank lenders, or at least asking for an exception. So next one, again, reduce or eliminate any outstanding debts where possible. Guys, credit card limits, it's a big one that we're seeing right now. If you're not using the full limit, lower it. Yeah, like 10, 15 grand credit card limits. the bank use 30% of that as if it's used. So if you're not using it, they'll still assume that it's used, which is kind of usually 35% of the balance, which is could be another $50,000 on the borrowing capacity.
Mm.
And again, you know that. And again, just going back through this, yes, whilst it is beneficial for it, please look at non-bank lenders as well. I'm not an advocate for non-bank lenders, just an FYI, because we talked about it today. I'm just like, there's plenty more than these big majors, which will get most media and screen time.
Mm.
Now, next one is extending your loan term. If you want to extend your loan term, lower repayments, yeah, there's only two ways you could do it. Internal refinance, right, with the same lender, it is critical, so you have to provide all your income documentation again, and or refinance completely to a different lender altogether. So that's what it is. So again, this is the kind of stuff that we do look for in what we do. As I said before, fixed rates is an early sign that interest rates will drop. So going back to the topic again, I know we veered off to policy, but when you start seeing fixed rates drop, we are seeing something on the horizon, and just and that's again what it is. So that's it. And again, why wouldn't RBA cut rates? I've already talked about earlier on. We talked about this up front, and other inflation pressures. Labor market is still good, and then uncertainty. So key takeaways from this webinar is a couple of things. So number one, Australian inflation rate has decreased from 3.2, lowest since 2020. Good to know. Number two is with some adjustments, we should see a rate cut happening, and then we should have some impact on borrowing, even though I'll be straight up, yeah. Like talking about RBA, give me the heebie-jeebies. And I'll tell you why, because banks tend to lend based on their own business and their own metric. And whilst RBA is a good understanding what the economy is doing, sometimes the banks move differently to what RBA does. And that's super important. Before, maybe 10, 15 years ago, when RBA did something, banks are on it. Boom, right? And that should be the indicator. Now, it's not really, right? Like if rates cut with RBA, don't expect that borrowing standards from APRA is going to change. It hasn't changed yet. It's just done a rate cut. That's what I'm saying. A lot of this RBA movements, a lot of this rate cuts is more psyche than it is financial. So here is a little bit of examples of kind of what interest rates may look like. On the top there is the loan. This is principal and interest. So and monthly. So 440,000 all the way to 360, and you can see what the drop looks like there from 125 points drop from 6.25 to 5%. Yeah. So with $300, $400 on the 440 side, is it? So is it massive? Not really. As an investor, maybe good, a couple of dollars here and there for saving for expenses. Now, I want to do a little scenario just because that way it's nice to understand what that may impact if they do start dropping rates. I've got a $100,000 applicant one, $100,000 applicant two, $10,000 credit card, one dependent. Yeah. So PAYG, FYI. So this is what it looks like from a borrowing capacity point of view. I've done the big four because we just talked about the big four here. Maximum borrowing capacity on these six rates is like that 929, 927-ish. You can kind of see what that looks like, right? And at the bottom, again, if rates cut and we're at the kind of 5.5%, maximum borrowing capacity increases 987, 989, 990. We're kind of playing around those components. And then look on the right-hand side, which is the monthly repayments. The monthly repayments have actually dropped. You could borrow more. Repayments have actually dropped, again, because of rates. And the servicing buffers is based on those rates. So just to kind of give you indication of will borrowing capacity be better? Yes. Is it going to be substantial? Probably not, right? But it would be enough to get you in where you need to be. So just more on your linings there. Now, we like sweeteners. I like sweeteners, and I saw myself in the last episode of that thing, and I saw my neck. So I've been trying to lose some weight. So we do like sweeteners. We've got to stop it. But we're going to do this for the first 10 refinances that hit us up. So at the end of this, Tim will put it together. We will pay for your membership. So it's the Hot Spotters membership. We'll pay it for the next 12 months. It's free. Tim has kindly helped us collaborate for those, which I think is awesome. And then as well as the best of bundle and the price predictor index is also free. So around about kind of $1,000 worth of hotspotting that Tim has been kind enough to collaborate with us on. And again, it will be for the kind of first 10 people that do end up wanting to refinance or restructure. Now, for the people that don't like me, it's okay. I understand. And if you have your own broker, that's all good too. If you like your own bank, I don't care. It is what it is. I still got love for you. However, if you want us to, if you don't want to refinance or you just want to get the rate reviewed to get front book rates, yeah, we have a dedicated person here purely for kind of hotspotting clients, and we have been helping quite a number of hotspotting clients over the last 12 months. It's been pretty good. But we could apply pricing on that. So again, we don't need to refinance. We don't need to do any of that stuff. We could apply loading, or we could apply loading. We could apply discretionary rates on that, argue for front book rates. And if they can't give you front book rates, we'll tell you if you want to go back to your broker or your bank and argue with them, you can. But we can talk about getting some front book rates. And that's for anyone. That's kind of no costing to that. Obviously, that's not a refi, so you won't get the free stuff. But we're just happy to do that because yeah, a lot of people usually hit us up after these webinars and saying, look, I've already got a broker, I just need some advice. And instead of just giving advice, and you already know most of these advices anyway, we'll just help with some of the pricing. So that's what we're kind of willing to do there, which is cool. Yeah, that is me.
I've thrown in Lucky's. Go back to your Insta tags and all that sort of stuff. Anyone wants to follow Lucky and reach out, do that. I've also put his the number in there 0451 888 798. If you text hotspotting, his team will reach out and organise to have a look at pricing for your mortgages, or if you're looking to invest and wanting to know what your borrowing capacity is, the team there at FinanceBetter are terrific. So recommend everybody does that. Now, in terms of questions, please start adding your questions to the Q&A. We've got some in there already. The first one that we have here, Lucky, is in relation to whether you're recommending for home buyers and investors, should they be locking in fixed rates or staying on variable when they see the rates change?
Yeah, buddy. Who asked that question?
Sally.
Sally. Firstly, Sally, that's a great question. I would actually be kind of sitting around. I wouldn't be fixing anything right now. The reason why I don't see it fixing right now is because usually if waves carry momentum, so if they are going to do a rate cut, I would wait until you should fix it. Most of our clients are on variable rates now. When should you fix it?
Yeah, it's a good question.
If in your mind, that rate is in target with your investment cash flow and you're comfortable to do that, it may be a tax play that you're happy to kind of do some gearing, if you're neutral geared, etc. And you're like, you know what, this rate I'm kind of comfortable with and don't want to take any chances. My suggestion, go fix it. If, however, you're like, you know what, I think I could bleed a little bit more. And if you are going to fix it, I wouldn't fix it for too long. I wouldn't fix it for your 3, 4, 5, 15 years, which some lenders are trying to do. I'd look at maybe say a shorter term, 12 months, maybe 2 years, but I probably wouldn't even do 2 years. Most of our clients, like I'll give you a perfect scenario with our one. We got some clients who are like, I'm happy with the rates right now. We've done some cash flow projections on their properties, and they're like, this is my target with my tax planning, with my cash flow. I'm happy to fix that. And then we'll be like, okay, we'll fix it for like maybe say 12 months and then see what it looks like from that component. So I know it's not the straight up answer, but depending on your scenario, there's kind of 2 answers there that you could pick from.
Yeah. Okay. And obviously it does vary depending on the rate that you're coming from as well.
Yeah, absolutely. Yeah, for sure.
Another one, we got one from Jenny that says, are banks starting to loosen their lending criteria, or are they still being conservative with approvals? It's a good question. So that's probably more in the policy.
Man, far out. Questions today are intense, eh? No jokes. No, look, I think that they are loosening to some extent. They are loosening more to owner occupiers than they are investors. We are seeing kind of lenders like example like Bankwest kind of loosened up a little bit. When it comes to investing, it's going to go back to individual situation. Have we seen it improve? I wouldn't say loosening because that's such
Mm.
an open word. Are they more open towards deals? Look, we are seeing some lenders do a lot of pushbacks because it goes without saying. They'll advertise that they'll be like, yeah, cool, let's take on business. When you submit the deal, based on that conversation that we have, we're like, you didn't want this deal, do you?
Mm.
So I think if you're in the investor landscape, um, to answer loosely, if you want a policy or lending criteria that's a bit more loose, your broker or your planner or your accountant, you guys should be having a longer conversation than just your first acquisition.
Mm.
If you guys are going through planning stage, you may go, I want 5 or 6 properties. What do I need to do? You may go, we should go to a very loose lender for the first two, structure it differently, and then go to the others. Um, but yes, we are seeing more looseness happen on actually first home buyers and owner occupiers than we are more towards investors, shading, security types, etc.
Okay. That's interesting. So I know on our TV show on Ticker, we did talk about that planning that you do. I know with a lot of customers that come to you for the first time, so I want to buy an investment property, and you go,
Yeah.
well, how many and over what
Yeah.
period, and all those types of things.
Yeah, of
So
course.
I know you guys do take a longer approach on
Mm,
this. It's not just to look at what can I get you today. It's about
yeah.
the structure, and I thought it'd be a good idea. We've still got a little bit of time. Did you want to
Yeah, yeah,
sort of
go.
touch
Yeah, I'm happy.
on what you've been doing for customers with trusts and things like you? Because I know
Yeah,
for a lot of
sure.
people in this high interest rate environment, they likely have reached a peak
Yeah,
of
yeah,
borrowing and they can't get any more. And I know
yeah,
that you've been
sure.
able to help a lot of customers, break down those barriers and get further lending. So could you
Sure,
touch
of
on that?
course. Yeah, look, let's a whole different webinar in itself, but let's go through it. So, whenever you guys go through borrowing, you will always have what's called an end, END. Yeah, that's it. So when you buy inside personal names, you will always have an end. That's all. So you're like, I want to buy some more, and then you come to an end, and then you go, all right, cool, I want to buy some more, Lucky, and I go, you can't. Doesn't matter what you do, how you structure it, there's no more. That you're kind of tapped out. And the only thing you could do is to sell properties, offload it, and then try to acquire more. If you want to structure it properly, there is a couple of lenders that would look at ownership of property within trusts. And then when you apply for the subsequent debts, some lenders may exclude that trust. I'll give you an example. Tim, you're a client here. So I'll be like, Tim Trust owns property one. That's with, say, St. George. Um, we then apply with um, ANZ, let's say, for Tim's trust number two. ANZ's policy may say that, okay, we know that there's a trust there. It is a holding trust. I just may need its accountant's letter that's taking care of its own liability. That's it, right?
Mhm.
So if
So
you
it's
think about it, if
excluding that debt from your
excludes
P&L.
that debt, there's other ways of structuring it where, if, for example, you have an investment that has a relatively big debt, you may want to put that inside the trust to help that exclude. Because that accountant's letter is based on policy. Some lenders don't need an accountant's letter. Some
Yeah.
lenders are just like, that's in trust, happy days, like whatever. That's the way they look at it. Now, there's been a popularity of trusts being opened up because it is a very new topic that it's just a very new topic. So a lot of people have been um, doing it and etc. and trying to attain property with trusts. Some lenders have made changes to that. Like, for example, if you buy within trusts, they look at it as obviously buying within company. You may have a higher rate than if you were to buy it in personal names. Yeah. The benefit of still doing it though is to maximize your borrowing capacity,
Mm.
right? Because in theory, having properties in trust, you basically have an unlimited borrowing capacity. It's unlimited. Some lenders, you can have multiple trusts inside the same lender and they exclude the trust, even though it's inside the same book, inside their own one. So let's say Bank One has Trust One, Trust Two, Trust Three, up to 72 trusts. They will all exclude everything, even though they have full visibility, because it's within their policy to lend within that trust and exclude everything else.
Wow.
That's the kind of stuff that you want to see. Now there has been major changes around that, and we've been in the forefront of that. But again, we've been in the forefront of that, which has been good. We've been actually educating a lot of brokers as well because they ask us like,
Mhm.
hey, who do you use and how do you like? Oh, we went to them and
How'd you
how come
get
we
that deal
couldn't get
across the
that?
line?
Yeah,
Yeah.
yeah. So it's definitely a pitch. Obviously, I came from credit. A lot of our guys have come from credit, so we're able to kind of restructure in a way that does that. That's what it does. Now, if, for example, you stuffed up, you go, ah, man, I should have known about this. And usually the first two, three properties, when you buy it in personal names, you're like, I bought it. And then suddenly you had an income raise and you're now in your eighth or ninth, you want to buy the next one. You're like, you know what? I want to grow a portfolio now. You're at
Yeah.
three or four, but you probably, what some people have done is push properties from personal names to trust. Now, the implication with that though is you are going to pay stamp duty. Again, yeah, you are selling it within the trust. The trust is buying it from. Now you can do that from an equity release. You just got to justify the reasoning if like why you're doing it. I'll give you a case study. Yesterday, we had a client, very big capital growth area. I won't say where, but very big capital growth area. There was no more lending, zero lending. They see somebody, all these brokers, all these banks, zero lending, right? So we were like, okay, cool. If you move, there's amount of equity here. If you move these two properties, the cost of doing that will you have to pay for your duty.
Mhm.
Again, they were like, oh, that's pretty crap, which it is.
Mhm.
But those two allowed them to bend by the next three.
So
So
that's
when
gonna
they were now
the
cut,
pros outweighed it. Mm.
correct. And for them, they were like, no, we want to keep buying, keep growing the portfolio, which has never been a conversation, usually with brokers or banks, or the first time you meet with them. Because
Mm.
the first time you meet with a broker or a bank, you know what the conversation is? Transactional. What is your interest rate? I should get something lower. Like that's not a
Yeah.
that's
Oh,
not a conversation you should be
what's your
having.
immediate need? We'll fix that.
Exactly, because an immediate need is immediate. Doesn't look at tomorrow or what's going to happen next year or the year after. Like
Mm.
we need to, you need to do it from the jump. Because if you don't
Yeah.
do it from the jump, from the start, my fellow hotspotters, if you don't
Mhm.
do it from the start, then you're going to come to situations like this that you have that you're at post planning stage, having to redo everything again.
Yeah.
So just some things to kind of be wary of.
Yeah. Very good. I got one more for you.
Yeah.
For those looking to refinance, is now a good time, or are we better off waiting for the rate cuts?
Oh man, I love that.
Yeah.
Um, going to go to personal circumstance. If for again, the rate cut is not going to affect the policy, number one, and what you're trying to do. If you want to refinance, do cash out, controlled cash out or uncontrolled cash out, to buy the next investment properties, there's better lenders that you could kind of go to get those cash outs. If, for example, you're just purely rate driven, you could wait. Yeah, you could wait. But at the same time, though, how far is the rate going to push you on the lower side? Going back to what I referred to regarding policy, is now the right time to refinance if you're only looking at the cost saving of interest rate, and that's all you're thinking about. Wait, uh, wait around. If, for example, you go, I need to make a substantial change and then take out what I need to take out, release equity, cash out, structure it. Yes, but remember this: it doesn't matter if you are same rate or not, or lower rate or not. When you extend it back to 30-year term, your repayments will still go lower. Yeah.
Yeah.
Like I'll give you an example. You have a 6% rate now, your loan term is 15 years, you refinance it to someone 7%, you lower it's back to 30 years, your repayment's going to be lower purely because you're extending the term, irrespective of rate.
Yeah. That's a good point. I've got another question here, which is with the current lending conditions impacting buyer behavior, are more people leaning toward established properties, new builds, or off the
Oh man,
so
bro,
probably more related to property.
seriously.
If you know.
Man, I love these questions, eh? Because last time we didn't have questions, and this is like,
Mhm.
yes. Where are people kind of leaning towards more? Look, like they are looking more towards existing. We know that what we've been seeing is definitely more existing side. We're seeing a lot of softening around that kind of off the plan play, on our side lending, that
Mm.
is. Maybe Tim has a different perspective of this. However, we are seeing a lot of construction numbers drive higher and get more approvals, which has been interesting. I think certain states for construction works, where there's kind of affordability there. Um, but in terms of lending, where is better, you probably get better LVRs and immediate delivery on existing security than you would do
Mm.
on off the plan or brand new. a lot of people that is going towards off the plan or house and land or whatever. So
Yeah.
um, usually it's just because of the longer delivery to you. That's all. Like there's nothing wrong with off the plan or house and land, etc. If the delivery was tomorrow, yeah.
Yeah.
If I bought a house and land now
Mhm.
and then tomorrow I get it, everyone will be sweet. But you're not going to get that. You're not going to get it in 3 or 4 months. You probably get it
Yeah.
in a longer time, and that's okay. Nothing wrong with that.
Yeah.
That's just the stuff that you'll just need to be wary of. But lenders have been doing that.
Yeah, I think from my point of view as well, what I'd say is that whenever you're looking to buy an investment property, you don't decide, do I want new or do I want established first? You sort of we believe that the location's going to do 80% of the heavy lifting for you. So
Yeah,
select the right area for your budget first, and then see
yeah,
in that area what do I buy at that budget?
yeah. I
Because
agree.
interestingly, we had a huge increase in construction costs over the last few years, but then off the back of low listing volume and high demand for real estate, we've seen a lot of markets that have had this huge boom in real estate
Mm,
values as well. And what's
of
happened
course.
is the values have caught up to the construction costs. So in a lot of
Mm,
markets I'm seeing now, you can actually build a brand new home for
mm,
similar to buy a 20-year-old home. So in
sure,
those markets, I think new build does make sense. You'll obviously save a lot on stamp duty, and what you're saving there can help go towards your construction costs. The interest that you'll pay waiting for construction. So I'm leaning a little bit further towards new build in some locations now, when
sure.
in previous years I wasn't. But yeah, it's an interesting space. But as I say, look at the location before you make a
Mm.
decision on which one you go
I'd
with.
probably add to that, Tim, just because you've kind of put a fire underneath me. Like a lot of these answers, in terms of security types, because there's sub-security types here. When you talk about existing, there's house existing, there's townhouse, there's apartments, there is dulux, there's co-living, there's that is in itself other subcategories of security types. Where you should be looking is actually where you can afford. So if, for example, your borrowing capacity is only 400,000, yeah, there's no point talking about something brand new or etc. because it kind of prices you out the market already. So I think the first step is where can you afford, and then from where you can afford, will tell you what security types there are, right? Like headline security types. And then from that, the sub-security types, which is if you're going to go existing, performance of townhouse, performance of units, performance of houses, and where are you excluded from because of your budget
Yeah.
and your policy on the lender, because some lenders don't like apartments, yeah?
Yeah, that's it. Okay, very good. A couple more questions before we wrap things up. So, got one from
Mm.
Renee. It says, there's two of
Hi,
them.
Renee.
So let me just see which order it goes in. So, what about when you liquidate an investment that is held in a trust versus held personally? How does the capital gains tax work? It's a good question. And
Accountant.
then I'll just see if you want to. Yep, and then I'll ask the next one next. So I was just seeing if it flowed on from the first question. So, first one,
Yeah.
how does it affect based on being in a trust versus personal?
Look, to be honest with you, I'm going to give you the straight answer. I don't know. I'm not an accountant. It's probably something that you probably need to speak to an accountant on that's going to go from your financial circumstance,
Yeah,
because that flows on differently to who's the beneficiaries, who's inside the trust, the incomes of those trusts, the incomes of their beneficiaries, etc. Obviously, there's massive implications. There's implications on putting it in trust as well as putting in personal names.
mm,
I think the demonstration of the trust was purely from the borrowing capacity point of view, where
yeah,
the borrowing could be grown for the purposes of having properties inside the trust. If, for example, you are going down that route, I like I say from the jump, we probably collaborate with your accountant and be like, the what's going to be the holding cost for the client in the trust? Is that going to be part of the work? Is that going to be part of the cost breakdown? What's liquidation that's going to happen during that component? And what
yeah.
happens if the trust liquidates itself? So a lot of those conversations do happen when we put properties in trust. Collaboration happens between usually myself or ourselves here, as well as the accountant, because we need to understand your circumstantial data.
Yeah. Look, it's one other point on that as well, Renee, which I think is really important, is that we have two different types of taxes here in Australia. You've got your federal and your state level. And, the CGT is a federal-based tax, but you've got things like land tax. And land tax can be very different in your personal name versus
Mm,
in a trust. As an example, in Victoria right now, if you own any real estate that has $50,000 worth of value in the land, which is pretty much every piece of real estate, you will start paying land tax on that. That's a $50,000 threshold on the land. You go into New South Wales, that jumps up to $1 million. However, it drops back to 300,000 if you own in a trust. So I had a lady recently who didn't know that advice going into it, bought a property in New South Wales in a trust. She's currently paying about $30,000 a year in land tax. So you need to get the right advice from the start. And that is a conversation, as Lucky said, not only with your broker, but also you need good tax advice.
Yeah,
The
sure.
next question following
Mm.
on from Renee is, what about your age when you refinance to extend the loan period? Does your age come into this? Are you limited to term of loan based on your age? I'm 52. Can I get a 30-year loan investment? Good question.
Yes,
Yeah.
that
And again, depending on if it's investment or owner occupier, of course. But
the answer is yes.
mm.
So, can I talk about this real quick,
Yeah, go for it.
Tim? Because a lot of people are going to be affected by this question.
Yeah.
So, whenever you are refinancing an investment, a debt, you could push it to 30-year term. What the bank will always ask you, is what's your exit strategy and where will you live after? They don't want to make people homeless, right?
Yeah.
So what they want to do is just make sure that usually they will mitigate it with amount of super or the remaining capital that's built into the investment, if there is, to then live unencumbered somewhere. What
Mm.
they want, though, is a clear exit strategy on it. However, like you could do a 30-year term. Case example, I had someone that was 65. Yeah, this was probably last year. We had to refinance the investment property back to 30-year term because the bleed was already there. There wasn't any cash flow, kind of negative geared. We pushed that off. It was kind of now neutral to positive, but there was a good a capital component there. The exit strategy for us was to sell that property. Unencumbered funds was to buy X apartment here or retire here, as all the bank will care about. If it's an owner occupied, however, owner occupied that you're trying to refinance, you have to give more mitigants on the strength of the exit. That is the big thing. They may give you a 30-year term, but some lenders are a little bit anal with that. But you have to give a best case use. And usually it's either savings, super, or the sell of the profit of the property to allow for a 30-year term.
Yeah.
It's a harder fight for owner occupied than it is investment to extend that.
Yeah, for sure. Very good. Okay, well, we'll make this next question the last one, Lucky. We've got one
Yeah.
that says, how many properties can you buy in a single trust?
Um, as many as you want. So you, in
In
a
one
single
trust, I think
trust,
it is. So yeah.
yeah. So um,
There's different types of
let's
trusts as well. So it would depend
yeah,
on that. And it also comes down to whether or not, how many other owners are in the trust as well. Because yeah.
correct. Like if let's say it's a pure discretionary trust, like just a kind of simple holding trust. Um, think of it like this: your personal have its own heartbeat. That trust carries its own heartbeat, right? So every single trust will also have an end. Let's just
Mhm.
leave it simple to that.
Yeah.
Yeah. So your borrowing capacity has an end. That trust will also have an end, right? And then you open up another trust, so on and so forth. Now, the biggest thing that people forget here is borrowing capacity is different to contribution. If you wanted to buy more properties, contribution will still need to be implied. Like a trust is not just like his free money at 100% OVR. That contribution comes from your pocket, comes from equity from somewhere, right? Which will then affect borrowing somewhere. So to answer that loosely, um, you could buy as many as you want inside a trust, but we'll come to a stage again that trust has bled out or is at end. Then you
Mm.
can open up another trust, and it doesn't fix that contribution factor. Like, where's the contribution coming from? Because again, you could unlimited borrowing capacity. Whilst it's the topic of like, oh, shut up, Lucky, like that, that's not right. It is right in
If,
consideration.
yeah.
You have unlimited contribution.
Yeah.
Yeah. And people are always going to be limited by contribution, as in deposits, etc. Then get the borrowing. That makes sense. Like if you want to, you could borrow $5 million, but if you got $100 to your name,
Mm.
what were you going to buy? Like what are you going
Mm.
to really
How are you
acquire?
going to fund it? All
How you
right.
can fund it?
There is actually one in there which relates to this. So I'll just say Michael's question before we wrap things up. Lucky, do the trusts that you're referring to require members to give personal guarantees?
Some some lenders will look at you, not personal guarantees. No, it depends on number one, the security. It depends on which lender. They look at you more as a guarantor than they do an applicant. So the trust is the applicant. Yourself is a guarantor. Um, in terms of personal indemnity, if you
Indemnity?
uh, it depends on which lender will do that. Some
Mm.
lenders don't, others will. But to give you an essence of what it is, the trust is the applicant. Whoever the members are the
Beneficiaries.
are the
Yeah.
guarantors. Correct.
Yeah. Okay. Very good. All right, Lucky. Well, it's probably about all the time we've got for today. Obviously, the topic of inflation and interest rates would usually have the blood running out of most people's heads, but you've kept it interesting. You're
Yeah.
a great character,
Thank you.
and we had
Appreciate
lots
you.
of great engagement out of the audience today. So thank you, everybody, for coming.
Yeah.
Really appreciate all the questions, and I do urge anybody not only reach out to Lucky and see what he can do for you and your finances, but also, obviously, if there's any refinances in the future,
Mm.
he's got some great deals from us at Hot Spotting as well. So
Yeah.
thank
Cool.
you all, and Lucky, let's do it again sometime soon.
Thank you, guys. I appreciate you guys. Thank you so much.
Thank you. Cheers.
See ya.